Well, anyhow, good morning, everybody. We're going to get started.
Oh,
I'm
exactly.
sure we'll have some more people filtering in. I'm very excited about this meeting for a number of reasons, and what we hope to accomplish is to tell you why to work with Main Street Planning Group and why to work with Ken Buckley. And very simply, premium financing is not your typical type sale. It's mostly for high net worth. Ken works with high net worth individuals, been doing it for, I don't know, about 30 years, specializing in this area of practice. When it comes to premium financing or large cases, what we recommend is first you establish that you have a client or a potential client who has a big need for insurance. Then when you come to us, we're going to help you case design that situation, whether it's a term product, a UL product, or a whole life product. What's the best scenario for that client? Main Street Planning Group works with 30 different insurance companies. The insurance companies are changing rapidly all the time. Some are coming in the market, some are leaving the market, some of their products getting better. And that's through both interest rate issues, regulatory issues. The products are changing. And some products work very well, and some products don't. The second piece of what we do is underwriting. Now, I have an underwriter on staff who was a concierge underwriter for MetLife. Oh yeah, that was a company that we used to do business with. That's not here anymore. And so the particular health situation, everything else is very important as to what carrier we select as well. One of the things that we do on the underwriting side is we make sure on our large cases that we do a cover letter. And cover letter, we could do a whole session on cover letter writing, but the importance of a cover letter in designing the case does a lot for the client. And what it does is it humanizes the client to the underwriter. So it's a real person, not just an applicant. We also go through the medical and financial aspects of the case and really set it up so that when the underwriter looks at that case, they know what to look for. And you also want to promote the highlights of that person, whether they're, a very successful business person, are they socially active, are they physically active, they know, listen, we all may have some health problems. What are they doing about their health problems? It's all very critical in getting the best underwriting class and working with the best company. And then when it comes to premium financing, we think that flexibility is a key. And the reason we have Ken Buckley speaking today, and he's one of our partners when we do premium financing, is because he's one of the best at what he does. And some of the things when you do a premium finance case, some of the things that you have to look out for is, number one, anytime you're in a large case situation, you're going to face competition. You may not know it yet, but it's coming. Whenever there's a large amount of money being exchanged, all of a sudden the competition comes out of the woodwork. Now that could come from an accountant. It could come from an attorney. It could come from the attorney's accountant. It could come from the attorney's representative. So one of the things that you need to do when you're participating in this type of programming is you need to know and do a deep dive discovery as part of your fact-finding process, who that client's financial influencers are, who their decision makers are. Now, I say that for a number of reasons, because if they don't know up front, the programmer, they're not on your team, they may be your competition tomorrow. So it's better to address them up front and explain the details. And why do you work with somebody like Ken Buckley? Ken Buckley can help you in that process, in speaking with the attorney and speaking with the accountant and speaking with all the intricacies. So Ken is terrific in that, in helping design these programs. In addition, Ken works with 28 or 29 different banks. Okay, in having the bank language absolutely correct is very important on these deals, so your client doesn't sue you down the road for doing the wrong thing. And there's many other reasons that Ken will go into about how he does his designs and everything else. But having those people on your team, Main Street Planning Group and Ken Buckley, is going to make your case successful. So with no further ado, I'm going to introduce you to Ken, who's going to do the bulk of the program. Ken, take it away, B.
Thank you, Neil. First of all, I want everybody to know that I've worked with Neil over several programs that have been successful. And by far, he is the best underwriter that I work with across the country. And he puts a program together, works well for both the client and also the underwriting process. We've had situations where we've gotten agents involved, and all of a sudden what's ended up happening is Neil will be able to get a standard risk with somebody else, will turn around and get table 1 or 2. So his underwriting is impeccable, and he does a fantastic job with that. And we've closed many cases where I don't think he thought we'd close them, but we ended up doing it. I actually like working with accountants to start off with, because usually accountants are the ones that are going to make the decision. So my whole thing is, in the beginning, let's drag them in, the CPA, the estate planning attorney, all of them, get over those hurdles, and then find a way to make this work that's advantageous for everybody. Just to give you a little background, I've been in the business for 43 years, which is hard to believe. My son, who's running the computer, he works for me. He's 34 years old. My cousin's son works for me, who's 36. My daughter works for me, who's 39, just to give you a background of some of our 9 employees. But basically, we have a program that we can continue this 30, 40 years down the line. So that's very important to know about. And I've been doing premium financing. This is my 27th year. So I've seen everything. When we're finished with this program, I'll open it up for questions. But today we're going to talk about premium financing in the term marketplace. This is really something for people that every CPA recommends term, every estate planning attorney buy term, and we'll worry about it 10, 15, 20 years from now. We try to convince the client, let's buy that term, but let's convert it now to a permanent policy where 20 years from now, you have something you can put in a drawer and forget about it. So I'll show you some examples of how that works. So without further ado, let's just take a look at a couple situations. When you look at term coverage, this is really what you're looking at. Number one, why do you buy it? Because it's inexpensive, or a lot less than the permanent. Number two, term insurance has no cash value, which is very important many times to start even getting a client. There's so many young people that come to me and go, look, at the CPA insists that this client buys the term. He's successful, he's just getting bigger and bigger. So I go, that's perfect. You should go in there and say to the client, look, I have a way for you to take term insurance for the same cost and make it into a permanent policy. Give me 30 to 35 to 50 minutes and I can answer any question on this. A lot of CPAs will let you go in the door for that. And because, hey, if a guy has an idea of making it permanent, let's take a look at it. Now, the worst case scenario, because this happens a lot to me, I'll say to the client, look, let's take a look at your term. You've had the term for 2 years. Cost of insurance is always going down, the COI. And so let's take a look to see if we can find you a policy and add those 2 years back so you have 15 years of coverage. And now you show them a policy that you can sell them on term. That way you have control of the client, and now you can work your way to a premium finance case 5 years from now, 7 years from now. Joey and I were working on a case on a 35-year-old, was it?
Yeah.
35-year-old, just didn't make a whole lot of sense to us. And the premium wasn't high enough for my 29 banks. So we turned that around and so ended up saying buy the term using the product that the agent wanted. We had nothing to do with it. We didn't get paid for it. And now the client, he has a client that case is going to get, he's going to get more and more wealth. And 5, 10 years from now, that's another premium finance case. So inexpensive, no cash value, set premium. Obviously, there's a set death benefit with term. You buy a $5 million policy, it's $5 million. It does not grow. It's only useful when you die, and I'll kind of get over that in 1 second. Renewal after expiration is very cost prohibitive. So everybody knows this. I won't take too much time going over this, but when you buy term insurance, what ends up happening, you get to the 2nd, 8th, 10th year, 15th year, all of a sudden you go, wow, I bought a 15-year policy. I'm in year 14. Next year, I have to make a decision. So the agent comes in and starts running those numbers. First thing they say is, wow, this is very, very expensive. I don't know if I can afford to convert there. If they have health issues, that's another problem. But what I really want to go over why term insurance has become a great moneymaker for the insurance industry and not for the client is really quite simple. 98% of all term policies expire before the client dies. So basically, the policy is going to die before the client's going to die. So the National Association of Life Underwriters, both Neil and I are members of. I'm also a member of the $1 Million Roundtable, top of the table, lifetime producer. If you take a look at, and they analyze the National Association of Life Underwriters, different things. One of the things they analyze is for every 100 people or 100% of all death claims, only 2 to 4% of those death claims are term policies. Think about this, guys. Don't term policy owners die, or is it the fact that the term insurance is not enforced in the day of death? So for every policy that's being written today that's term, the likelihood of that policy being paid out is 2%. 2%. So that insurance companies over these years, in the beginning in the 90s, when A.L. Williams came in, nobody wanted you to buy term. Then all of a sudden, what did the insurance industry do? Let's improve this product. Let's keep the costs down. Let's find a way that we can be part of this marketplace. And they got into the marketplace because they knew what was going to end up happening. Now, what ended up happening is all of these policies are dropping and so many of them are not being renewed. So let's find a solution for that, especially for clients that are worth $5 million or more. We're looking for a face amount of around that $5 million. And in our particular case, you'll see some of the premiums that we can, the higher the premium, the more banks I have. And every single time we have 29 banks, we're going to get at least 4 bank solutions at the end of the process. And it is a process. So let's take a look at the permanent coverage. More expensive, accumulates cash value. Many times the coverage can offer all the way to age 20. We run it to a minimum of age 100. We basically like to see it go to 120. And many of the policies have guards on them that automatically kick in to make it go to 120. The flexibility of the structure of the original policy. What do I mean by that? Many times when we have clients get into premium financing, this is a long-term affair. So what ends up happening is 7 years, 8 years, 10 years into the policy, the client may say, I don't know if I need all of this coverage. Then we can discuss how we can make adjustments on that. Most of the time, or not most, just every time, we use option 2 death benefits. So you get the death benefit plus the cash value minus the loan. That death benefit is growing. And if there is a need in the future that you want to reduce it, you can do that with the flexibility of the structure, as long as you do it after the 7th year. And there are limits with MEC laws, which I'm sure everybody here knows, but can be discussed if you have questions on that later on. So the flexibility is incredible. Option to adjust the policy, obviously needed. Limits on longevity risk. You're really not going to have a risk there if you go to 120, because not too many people make it up to 120. So we can adjust that, where on the term side, you can't do any of that other than drop the policy. Let's take a look at some actual cases that we've done. And these are 3 examples of people that I've worked with across the country. I have agents that I'll read some letters from the agents I work with. One of the reasons you want to work with the Buckley Group, we work with a lot of people around the country, and we have thousands of clients. Why is that important? I've written business personally. The only reason I ever got out of just doing the business on my own is I was getting so many phone calls from people asking me, how come yours works and mine doesn't? And then eventually, by having my son in the business, my daughter in the business, my cousin's son, I realized that I could have a continuation program. So what ends up happening is when we look at this program, we're looking at this on a long-term basis. But when you have a client that says to you, you know, Neil, How many of these have you written? 3, 4, 5, 6, none. I have some agents that have written it. How would you like to have 5 referrals? Any industry. We have doctors, we have dentists, we have construction workers, we have contract guys, we have, you name it, we have it. So what we do is we'll line up referrals for the client where they can talk to actual clients that have been in the policy 15, 20, 30 years and or close to 30. We've paid the bank back. So we're going to be able to give you people to talk to, and that makes all the difference when it comes down to closing. If you have any competition and they ask that same question when I'm there and say, why don't they give you the referrals they have, Glenn, and we'll give you the referrals we have, and then they turn around and make those phone calls. Every single time I've done that, we close that case. That is a big difference. 35-year-old preferred non-tobacco for 20 million. I'll show you an illustration of this in a second. This individual we put the 16-year payments because it was a 20-year policy. We're showing the 15 years that are left on the policy. And the policy is $9,215 per year. Obviously, it lasts to age 55, and then the client has to make a choice. One of the things we do is we show what the cost would be with that company for permanent if they were 55 based on today's product. Obviously, over the next 15 years, they could add products, subtract products. Now they'll be able to convert that policy, no health questions. So that's a great thing to happen. But when they look at the premium, they start going, I don't know if I'll be able to afford that $20 million policy. Now, 20 million is a large face amount, but what we did is find 20s, 320s and for a person 35 years old, but you'd be surprised what's out there. $9,215, we did that in interest payments for a period of 15 years. The collateral was returned to the client in year 15. The policy lasts to after 100. In this case, it lasts all the way to 110. We'll show you exactly what that looks like. The next one down is a 40-year-old preferred 20 million, 22,190 all the way to age 60. This person, I don't believe this person was preferred. I take that back. This one, that should be corrected. 22,120 in interest payments for that 20-year period. This policy lasts all the way to age 120. And the last one at 65 is a 10-year policy. This individual was going to pay $94,470 per year. Instead of doing the 10-year policy, they took those interest payments for that 10 years, paid back the bank in year 15, policy lasted to 108. Based on illustrations today, which are pretty low, these illustrations were based at 5.5, even though the illustration go as high as 6.2. So let's take a look at just the first one, because that's really what we're going to have time for. And we do a one-page illustration. We enclose all 55, 65, 75 pages of the illustration, which we'll go over with the accountant if they wish to. But we take that illustration and then we match these numbers up. So by doing that, what you're doing is I'm showing you the number, the $622,954. Is that correct, Joe?
Yes.
That premium we match up. We're going to blow this up so everybody can see these numbers too. And if you can't, please unmute yourself and let us know. But you take that number and you're going to show it under the premium financing side. So instead of paying the premium, we're going to borrow the money. Now, when you borrow money, it's tax-free. So one of the things I say to the client, you're 35 years old, you're paying $9,000, not a whole lot of money, but you're paying taxes on it. Now, if you live in the state of New York, that $9,000 is costing you how much? Closer to about 18, considering the state of New York, if you're earning any kind of income. So now I have the bank give me $622,954. The beginning loan balance would be the $622,954. Our interest rates with our banks range from a LIBOR plus spread, which can be as low as currently 0.95, which is amazing. That's a relationship bank. With a relationship bank that goes up to a 1.35, a non-relationship bank will range from anywhere from 2.55 to a high of 3.25. So we wanted to show the high interest rate. By the way, The banks that we work with, we have fixed rates for up to 10. Some of our banks are 15 years. So we can always do the fixed rate. And we do that with swaps with every one of our banks. And we can go over that in a further discussion. But here's an example. $9,215 he's paying in interest. Now, in that given year, his loan interest would have been a total of the $9,215 plus the $11,031. So this individual is capitalizing the interest. Now, I have some insurance companies that allow that to happen based on the financials. I have some insurance companies that won't allow that to happen. The banks that I use in this particular case, there are about 6 of them for this individual. So I narrowed it down to 4 for this person. We made the decision, but we rolled some of the interest into the policy. The end of the year loan balance, $633,985. Some people may ask, well, why is it different from the original payment? Because again, I added $11,031 to that, and that's my total end of the year loan balance if I wanted to walk away. So the cash value based at what interest rate on this, Joe?
I'm not upset.
What estimate?
6.
Yeah, around a 6% interest rate would be $554,573. That's the cash surrender value. Let's move that over. And again, if you have questions, jot them down and I'll go over all of this at the end. Now, this is the biggest problem that most people have with premium financing. The difference between those two numbers is only $79,412. That's the biggest misconception about premium financing. That number is not required collateral. We like to call that required walkaway collateral. So if you want to walk away from the policy, that's what you're going to have to give up. You paid the interest of $9,000. You have to give us the $79,000, letter of credit, lien on a brokerage account, depends on the bank. Every bank's different. Cash value of another life insurance policy. I have another presentation I do, and we do a ton of this, where we have foundations, where we use the now existing insurance of people that have already done their estate to purchase premium financing policies with minimal out-of-pocket expense. People love that. So you run into an estate planning situation where a client says, I want to gift more, we have a solution. So that $79,000 is the walkaway collateral. That is not what your collateral would be, because what are you going to do next year? You're going to borrow another premium. When you borrow another premium, you're adding another $600,000 to your loan. The insurance company and the bank do not look at this policy of what it looks like in the 12th month. They're giving you another premium, so they need to look at what it looks like 12 to 14 months from today, if today was the renewal. So with that in mind, that means that your collateral requirements, if you pull that over, Joe, are going to be between, oh, we only did 2 columns of this one. Yeah, $134,869. So that would be your required collateral. Now, again, if we have years where the policy has no performance whatsoever, the collateral could be a little bit higher than that. So we have a third stress test that we do, but to keep it on the screen, we could only do 1. So we'll show that to the client also. So we're going to say, this is what the policy would look like with 10 years of no return. I'm not saying that's going to happen, but if that high point of the collateral is 551, that number may be 7, 8, 900,000. So then the client knows what the collateral is. And that's so important. So when we do our reviews 90 days prior to them coming due, we make sure the client understands what's happening. And the client will say to us, oh yeah, you mentioned that, Ken. The collateral could be as high as 256 in year 2. Now I understand why it's there. And we go through that with them. And we show them those numbers. That's so important, so nobody is surprised in year number 2. And I always say to clients, if you don't have the collateral, this is not for you. And many times we'll show them double the stress test So they're aware of what the collateral is going to be needed if in fact we have 3, 4, 5 years. We do other things like cost averaging. So what we do is have buckets coming due at different times during the year. We have relationships with our banks that we don't need to have the collateral in 60 days ahead of time, 30 days ahead of time. We will say to the bank, we're going to wait to fund the policy until the deposit goes in for the return. Now, most people you work with do not do that. We do that because we have the relationships with the banks to be able to do that. We have cases now where we have 3 buckets coming due over the next 3 months. If things stay the same, what's going to end up happening is they're going to have double-digit returns in each bucket, which means they do not have to increase their letter of credit. The bank's just going to renew it, which means that the client doesn't have to give us any additional collateral. They either have to make their interest payment, or if they're not paying interest and they're rolling it, then that'll roll into the policy, and that's included in the collateral. So we can customize the program to meet the needs of the client and their advisors. Why we want to have everybody there. So, Mr. Estate Planning Attorney, we went over this with you, correct? Yep, the client understands that. Mr. CPA, Mrs. CPA, Mrs. CPA, we went over this. Yes, I remember you reviewing this. We do it 2-3 times. We get them involved. We show them the risk of premium financing. That's the most important thing. So now let's go across the outstanding loan in the first year, $633,985. The net to the ears, and like I always like to say, both income and estate tax-free to the irrevocable life insurance trust, $19,920,588. If this was a business situation, it would be in the LLC. And again, one of the things that we do with every one of our banks, the ILET borrows the money, the LLC borrows the money. I make the bank come to the closing. Even with the virtual closings where we sign them online, we make the bank come. Why? Because I want the banker to say to the client, this is a non-recourse loan. There's no guarantee here. The only fees included on this loan are fees that the bank has to have for using outside counsel to do the closing paperwork. That is so important. So many times people do a premium financing case, and guess what? I've seen them this year. I get called in on cases where they say, we'd like you to represent. I go, look, I don't have time to do this. You can't pay me enough money. Occasionally, I get paid enough money to be a witness for the person who's suing, whoever they're suing. And they'll say to me, well, why was this $250,000 fee there? And I just shake my head. And, you know, the insurance agent wanted to make 100% commission. So what does the bank do, or the organization that's loaning the money from a bank? They have a fee on there. And in this particular case, it was $250,000 fee. Think about capitalizing that year after year after year after year to be able to get 100% commission. The policy has to blow up. It has to blow up. So think about the policies before you go out and do premium financing. Make sure that there's good costs for the client and there's a good cost for the agent where he's going to make a certain amount of commission, but there has to be blends. This has blends of probably 60-40, where 60% of it's permanent, 40% of it is term. So you have to do those types of things to make the policies work and for them to go to age 120, 110, 105, and to pretty much guarantee that. So there are probably going to be a lot of questions on this portion of it, but for time restraints, I'm going to kind of just go down and show you how this works. So we're going to pull it over to the side to show you all the premiums that are included. You'll note you got 622 the first 3 years. You cannot create a MEC. Everybody here should know what a MEC is, or you wouldn't be in the business. So you have to reduce the premiums based on that. The premium might have to even go down further. We've had returns, and I can show you this, where we do cost averaging every year. We have the premiums being borrowed at different times. So instead of putting the bucket in January, you might have another bucket coming in March. You might have one coming in April, May. You might have one coming in July. So you're doing some cost averaging. So last year it worked out perfect for clients because they didn't hit the bucket in the beginning. But then when the market came back after April, they hit 3, 4, 5, 6 other buckets. And even the buckets in March that had minus 22%, no big deal, because they didn't get charged a penny out of that bucket. The only thing coming out of that is the cost of the insurance. Now, what happens to the other bucket? It made 12%, 8%, 9%. So when you average it out, pretty much every year we're getting some type of return. And that makes a big difference over the long haul. I have clients that'll talk about this. And there's nothing better than having a client call a CPA or a CPA call one of my clients. CPA calls me back and go, boy, that guy knows a lot. Yeah, because we educate them every single year to show them how it works and why it works. Now, loan interest balance. Now, you note that in the interest rate, we don't do big increases here. I believe 15 years from now, this interest rate is going to be a lot higher than that. The reason for that is interest rates start going up as they were a couple of years ago. We were locking people in, and we were locking them in at like 3.55, and they were happy. Now they're sitting there going, Ken, I would have been, based on the LIBOR and my spread, I would have been 1.78. I go, you're 100% correct, but you were nervous about interest rates going up. And when they go up, we can lock it in for up to 10 and 15-year periods. There is a cost, but not out of pocket. It comes in additional collateral. And there are ways where there is very minimal cost, and we have several banks that have different strategies on doing that. Now, we do have some banks that charge fees. We bring that up to the client to show them this is why they charge the fees. Is it worth it? Well, you got to take a look at it. That small fee may guarantee your rate for 5 years, 6 years, 7 rates. That's what some people want that. We give them that. So we can customize these programs to exactly what the client needs. But if you think about this, they take that $9,000, put it into the policy over a period of 15 years. We then have $7,860,436 at about 6% that allows us to pay back the bank in year number 16. And they have 1.5 million into the policy. And the only reason this does lapse at some point is because if you go over to the right-hand column, we only have the 1.5 to pay for the cost of the insurance. This is a policy that contractually gives you a participating loan. I'm not going to go through that, but you should, everybody, I believe, on this conversation would know what that is, where you're allowed to get the full investment on the 7.8 million minus what you're paying the insurance company for the loan. But we have to take the death benefit, which would have been a net 21, reduce it to 17. If you keep going up, you're going to see that this will continue. Oh, it's cut off there.
Yeah, because we need to.
I'll read you the numbers on the presentation I have. By the time the gentleman is 80 years old, the death benefit has grown back to $42 million. Does the next column have that or no? You don't have this page?
Hold on, it might just be. I gotta exit out. Not that far.
Yeah, here we go.
There you go.
So if you go to the 80-year-old and you follow it all the way across, it has 22,848,833 in cash. It has 38,848,833 in death benefit. Wow, that's pretty good. And again, based on a 6% return. And the likelihood of a 35-year-old dying at 80, probably 60, 70%, you know. Now, let's take a look. And again, we'll have time for questions, Neil. So
Yep, absolutely.
let's run through the way we try to design these policies a little bit. Depending on the age of the individual and what we're trying to accomplish. And remember, the best possible policy out there is the one that stays in force. That's my opinion. And I'm sure people here agree with that. If we go to a client and you sell them a term policy, that's your policy. There are many times when we design these, and it doesn't happen often, but it has happened. The clients come to us and said, you know, Ken, this policy, the way it's designed, I'm going to pay the premium. And then we don't put as much excess money in it because you don't need it to pay the bank back. So then we'll co-design that. We do not go on the app in those cases. I've had agents who have paid me, but that's totally up to the agent because our job is to do the premium financing case. And if we're not, but if the client wants to do that, we're fine with that. What's the best way to buy insurance? Pay for it, I believe. So we don't have a problem with that. So, but what you're going to find when you get these policies, the guy who was applying for the $2 or $3 million policy, when he sees the premium financing and what it cost him out of his pocket, he now wants to insure himself properly. That's when you're going to get the 10, 12, 15, and $20 million policies if he has the wealth, obviously. But they don't mind doing that because the cost saves them between 85 and 98%. So the number one thing we do is overfund the policies. Why would you want to overfund a policy? That excess money only has a one-time fee coming out of it, very minimal, anywhere from some companies 1%, most companies in that 3% range. But that's it. After that, that's only going to build up. So all your arbitrage, the difference between the money that's building up in the policy and the money being charged, you only have to have a change in that for this to grow substantially. So you're not taking out the cost of the insurance or fees or anything like that. We do both policies. Many times I'll show a client no rider, more collateral up front, but in the long haul, depending on age, you could save as much as $1 million in fees to $1.5 million to $2 million by not taking the rider. And the collateral actually disappears sooner. There's a lot more up front, but we custom design it to show it to the client. So you can see now we're educating the CPA, and that's what CPAs want. Show me why this will work. Give me people to talk to why this will work, and I'll recommend it to my client. Nowadays, you have so many CPAs that have a licensed agent there, so we have to include them. And an agent always says to me, I don't know if I want to include them. And I always say, you include them and see what happens. And instead of getting one case, you're getting 10, 12, 13, 14 cases. Neil and I know an individual, Sandy Cohen, who basically lives in Florida in the winter and plays golf, and comes up in Long Island in the summer and plays golf. So he's a semi-pro golfer. He should be a lot better than he is, by the way, from what I hear. But he gets all his business on the golf course. And I'll read a letter of some of the things that he's talked about our organization, of what he's done with us. Loans come from the bank, again, tax-free, not a MEC. So it's not a modified endowment contract, because we want to borrow to pay the bank back. We always want to get rid of the bank at the Buckley Group. Really makes a lot of sense. There's no cost commission on some of the premium, because we're adding that term rider. We don't get paid for that. We really create a lot of value in these policies. If you have a rider on it, you can have anywhere from 84 to 98% of your premium is cash from day one. So think about this, Mr. Client. You're borrowing $1 million premium. Yeah, that makes me really nervous. Okay, you're not borrowing it. The ILET's borrowing it. So it has nothing to do with you. Number two, if you have your preferred non-tobacco, 98% of the money you're borrowing is cash. So on $1 million premium, you're giving us collateral of $20,000 in the first year. That's really not that much. Now, the commission's lower, obviously, than if you wrote $1 million target premium. That makes sense. Less exposure, lower cost per thousand. Loans have no personal guarantee. Again, the client has nothing to do with it. When I go to the closings, and we have, in a lot of our banks, we have 12 pages. If we have a collateral assignment on a cash value policy, it's a little thicker. But if it's not, it's only about 12 pages. And with no personal guarantee, the ILET's borrowing the money. And in the paperwork, I make them put it in there. The trustee is acting as a trustee, not as an individual. That is so important. If you want to do a business buy-sell agreement with 3 or 4 brothers like we've done in the past, or 5 brothers or 5, 6 partners one time, we have LLCs, and we did them as shell LLCs, and the only thing in there is the life insurance. Really makes a difference. So many times these people sign limited guarantees, and I look there and I go, I want to get out of this note. Is there anything you can do, Ken? I'll pay you whatever you want. Well, if you walk away from the note, you have to give them $235,000. Why? Because that's the prepayment penalty. You wanted the 10 years of coverage, the 10 years of premiums. I've never had a problem getting money. Getting money on these types of loans is not a problem. I can get you a relationship bank. I can get you a non-relationship bank. You can give me a letter of credit. You can give me a piece of paper that says that you're good for the 80,000, 120, 550, whatever it means. And so many business people appreciate that because they can take their money and put it out in the street and make a heck lot more than paying a premium of 138,000, 360, 540. Every client I've ever talked to, what are you paying in premiums? I'm paying 535,000. Individual worth $120 million liquid. I go, no, you're not paying five. Don't tell me what I'm paying. I know what that check is. I write it out every year. And I laugh about it. And I go, I want you to tell you something. You're actually paying taxes on that 530. Don't tell me that. Yeah, you're giving me a net check. So that in your tax bracket, you're talking about paying me $1 million. You're paying $1 million for that premium every year. If I can do the same thing with collateral and save you 80 to 90% of what would come out of pocket, wouldn't that make more sense? So think about the whole process. And if you get in the door with the CPAs, one of the ways to get in, and I'm going to hold this up, these are our certificates. You probably can't see it too well. Okay, I'll just read it. Good for complimentary online CPE course for accountants. And it's good for 12 credits. We give each CPA that'll listen to us about the presentation 24 credits. Neil, we've done these before for you,
Yep.
Correct?
Yes, absolutely.
Yeah. And we pay for breakfast or lunch, totally up to the client, meaning the CPA. They get the whole office in there, and then we can discuss things like this. Everybody sitting there gets up to 24 hours of CPE credits online. They pick the course they want, prepaid. It's worth about $350 to $450 in cash, and we pre-buy these. And so we give every participant that. Again, free breakfast, free lunch. I've done them on April 15th. So don't tell me that you can't talk to these people until after April. And I recommend after April, but get them by May because otherwise they're on the golf course. But they'll do this for breakfast or lunch to get the CPE credits. And guess what? They learn something, turn around, and we get clients from them. It really removes the life insurance from the commodities market, makes it more of a solution than a product. This is my 29th year in premium financing, my 43rd year in the insurance business. I discovered premium financing because what was happening to me, and it's probably happened to some people out there, I was writing life insurance policies. And next thing you know, as soon as the cash got in there, they're borrowing from the policy, even though the island owns it. They're telling the trustee to send the premium in. Excuse me. And what ends up happening is that the policy would end up dying. I had clients have 7, 8 policies, and then it would die, and we'd rewrite the policy of right term. And I used to say to myself, you know, the only one getting this working for is me. I'm getting paid, but I'm really not doing my job. Premium financing, these policies are going to last if they're designed correctly, and you do the right thing for the client, and you're not looking off for commission. Now, 28 years experience, we have about 10 carriers we use. That will fluctuate to as little as 6 to as many as 12, depending on caps and other factors and ratings. Remember, you must have a minimum of an A rating. And the banks really want A+. If it goes down to A-, by the way, and a lot of people don't say this, banks, they will up the interest rate. We do have 29 banks available for funding. We have about 5 relationship ones. The balance are non-relationship, which means you can have your money anywhere. They'll put a lien on the collateral. They'll also take cash value of other life insurance policies, brokerage accounts, you name it. So letters of credit, very popular with our business people. Letters of credit work the best. We get in a relationship with the bank. We call them every year. We do the renewal. What do we have to give you, Ken? Nothing. They up their letter of credit. And we also have relationships with the insurance companies to custom design it so we can roll some of the interest depending on the situation. We always present 4 bank options at the end. So the client decides which one's the best. Sometimes if we have different situations, we could go as many as 6 options so they can think about it, and they may want one feature they like. Each one is a pros for this bank, cons, pros, cons. Really helps. We have no loyalty affiliation with any bank or insurance company. We do like some insurance companies better because we feel they have better and superior products, but they're not always available in every state. Nobody knows that better than New York. But we don't have any alliance with anybody. We want what's best for the client. We have no in-depth relationships, meaning that we have to show you this bank. We don't care which bank you choose. We just want to be able to work with the bank, and we have some we like and some we don't, but I'll work with people I don't like. I do that every day. I'm married. So insurance company, making us truly neutral when you get to the design. So we're really the one expert team that's designing this with your client in mind. Again, we're not cheap. I don't know if Neil has mentioned it. We're 40% of the app, but I want to give you an example why we're worth that 40% before I open it up for questions. This was written to me a while ago, and I have copies of this, but over the past 8 years, I've closed dozens of cases by partnering with Ken Buckley and the Buckley Group. At first, I was hesitant to partner with Ken's team, not because they had doubts of their abilities, but I met Ken several times. This guy had seen me in 3 or 4 different meetings, believed he had the knowledge and skills to close premium finance cases easier. But honestly, the reason I hesitated because I didn't want to give up any of my commission to get the assistance. I heard Ken speak at several events, and he went on and on about different online things that I had done and when he saw me. What I can tell you now with certainty is that the company that charges a fee to my client and doesn't go on the application does that because they have no intention of being there for the life of the premium financing contract. Every single presentation you get from us has the Buckley Group Inc. on it. We're standing behind the presentation, in front of the presentation. We're not disappearing. So many presentations that are given nowadays, you know what? They're going to have your name on the presentation. The reason your name's on the presentation is because they're only providing you with the bank. So if your client wants to go after them, they can't, because they signed the document stating they didn't give any advice. They didn't give you any information. They're just providing the loan. Now, 3 years from now, if they don't want to provide the loan, guess where you are? Trying to find a bank. And that's one of the most amazing things that helped this individual. But just give you an example, I don't want to read all of it. The Buckley Group was the financing with the same attorney that had recommended us and up the death benefit coverage. We wrote a second case on the client because when they originally did it, we told him his estate planning attorney was wrong. We ended up writing a second one. And between the two, I netted a commission of over $1 million. So that's just an example of some of the things that we do. We basically will take this program from A to Z, and we follow it every year. My cousin Peter's son works for me. He does all our banking relationships. He's the one that does all the numbers for the banking. Both Joey and I will do the design. Joey does more of it than I do. Any questions you have, you can go through all of that. Once we're done with the questions, I'll leave you my number, or you can call Neil directly and he can get in touch with us that way. Thanks for the time, gentlemen. And if there aren't any ladies on here, thank you again for the time.
Yeah. Is there any questions? I just want to add 2 things to this. If you don't think estate taxes are coming back into play, you're not really listening to the news. We're in such debt, both statewide and federally, that they have to recapture some of this debt through taxes. State taxes, some of the proposals right now are not only taking the taxes down, but also possibly getting rid of some of the step up in basis and many other things. So the state taxes are prevalent. Your clients that were worth 5 million to 10 million who thought, oh, I'm not going to have any taxes. Well, now's the time to plan. I just wanted to say that. Secondly, one of the advantages of doing premium finances instead of paying for it outright is there's a couple. One is if you're using out-of-pocket money, as Ken said, you're really paying tax on that. That's after-tax money, so that's costly. Secondly, Ken also mentioned the use of that money. Anybody making serious money now, doing real estate, this and that, knows the value of money. What's the use of their money? $1 million is worth 10 or 20% to them. So why are you going to use your money that you're earning 20% with? Why not borrow it? And the last thing that Ken doesn't point out is this issue of gifting. There is gift tax over a certain amount. Here, you're only gifting the interest to the islet. The money you borrow, you're not paying gift tax on. It's a tremendous saving for those in that premium finance market. So I just wanted to add those three things. I want to open it up to any questions. Does anybody have any questions at this time? Yes, no, you can raise your hand or hit in the chat button. I am recording this, so for everybody that's been in attendance, you'll get a copy of this. And if there's not any questions, have a great day. Thank you for your time. And
Thank you,
again,
Neil.
we're available.
Thank you, Neil. Good job. Thank you, Ken.
Excellent.
Thank
Thanks.
you.
Good to see you, Mike. As
You as
always.
well.
Got a haircut, I see.
Now pull it back.
I know you pulled it back. I love the COVID look.
The COVID look. I love
Mike,
it.
have you ever met Ken?
No, it's the first time.
No, I want you two
Yeah,
to
Mike.
meet. So
Yeah.
Mike is a regional, I don't know what your title is, like a
Sales director.
sales director for Lincoln. And he's a terrific guy and a terrific advocate for us, you know.
Okay. Sales director for who? Neil, I didn't
Lincoln
catch.
Financial Group.
Oh,
Lincoln.
Lincoln, sure. Yeah,
Yeah.
So
Are you working with Lincoln, Ken?
I am not. It's a product that we've looked at. We like it. Just really haven't had contact with anybody. So at some point in time, send me something. Send me like a 55-year-old, whatever state you want. Give me an illustration. I'll have Joey run it through our system, and then maybe we can pop on the phone and discuss it, because I'd be happy to add them. I do know that Lincoln wants interest every year. I have several companies that are that way.
Well, that's not, we made modifications on that. I don't want to take Neil's time unless you want to stay on, but we've made modifications depending on the net worth of the individual.
Yep,
The higher the net worth, we'll consider accrual of interest. We
perfect.
also have a rider that's available that fully collateralizes the loan, guaranteed for 7 years. Used to be 10.
Yeah.
Now it's 7. So it's very attractive. We do a lot with that. But yeah,
Well,
no, I'd like to.
Well, can I give you my phone number?
I already Googled you. Yeah,
Oh, you
if
did?
you have a direct line, that'd be great.
Yeah, my direct number is my cell, which is 508
Mhm.
789 8346.
Great. Yeah, I'll reach out to you, Ken.
That'd be great.
Yeah,
Thanks again, Neil. If
Thank
have
you.
any questions, just give me a call. Nice meeting you,
thanks,
Mike.
guys.
Yeah, you as well. Bye-bye.
All right, bye-bye.